Now that we've talked about how we record transactions in the accounting equation by using accounts and debits and credits, the next is how do we record the transactions within what we call the accounting cycle. We talk about an accounting cycle because there is a specific process from the transaction point till the creation of financial statements. All transactions must be supported by source documents. Source documents such as sales slips, a check, a bill, cash register tape, or some evidence of the transaction. Of course, the best source documents are those documents that are created by an independent source outside of the company. However, there will be source documents that are created within the company because those are the supporting documents that show that a transaction has occurred. Once we have a source document, we analyze the source document and record it in a journal. A lot of times the journal is called the Book of Original Entry, in that it is the very first place that we are recording the transaction in our accounting records. The journal is recorded in chronological order. So if you think about this is the place that we're recording every transaction in date order. Very similar to a diary or a blog that you use in your individual lives. By recording the transaction in a journal, we'll have a complete listing of all the transactions that have recorded in date order. This will be very helpful in the future if you need to go back and see if you've made any mistakes in the recording process. We call the recording of a transaction into the journal a journalizing. So here's an illustration. Presented below is information related to Sierra Corporation. On October 1st, Sierra issued common stock in exchange for $10,000 in cash. Also on October 1st, Sierra borrowed $5,000 by signing a note. And on October 2nd, Sierra purchased equipment for $5,000. So let's go and put these transactions into our journal. So here's our first transaction of $10,000 of cash being increased and $10,000 of common stock being increased. So when we go into the general journal, we put the date in the date column, the account titles of cash and common stock in the title column, and then we put the $10,000 debit to cash and a $10,000 credit to common stock. Remember, cash is an asset, and the asset is increased by a debit transaction. Common stock being on the right-hand side of the equal sign under stockholders' equity will increase with a $10,000 credit. The next transaction of Sierra borrowing $5,000 by signing a note, once again, cash increased by $5,000. So therefore, we want to put a debit to cash. The liability of notes payable also increased. And remember that T account that a liability increases with a credit. So we put a credit entry into notes payable. The third transaction on October 2nd, where Sierra purchased equipment for $5,000, once again, they increase an asset called equipment by $5,000, but look what happened to the cash. The cash went down by $5,000, so we want to place the $5,000 to show cash decreased on the credit side of the journal. Once we've recorded all the transaction in our journal in chronological order, we then want to take each line item in the journal and then separate them into the various categories so that we can summarize them for the period. So we want to take each line item and we want to post the journal entries into the ledger. The ledger is the listing of all the accounts or categories that we use in our company for financial reporting purposes. So every company is going to have what we call a chart of accounts, a listing of the accounts that the company uses to classify and sort information and transactions. What we take is the entry from the general journal and we post the individual line items into the individual ledger accounts in the general ledger. So looking at the first transaction that occurred in our example on October 1st, we will take the $10,000 debit entry of cash into the cash ledger account and show that on October 1st the stock was issued for $10,000. Note the reference in the journal and the ledger. The journal reference is to the account number. The ledger reference is to the page number on the general journal. This slide illustrates what we did for the first event. First, we identified that we had a transaction on October 1st for $10,000 and we made the analysis of how it affected the accounting equation. Once we've determined how it affected the accounting equation, we could determine what the debit and credit entries should be so that we could place it in the general journal. We recorded it in the general journal as a debit to cash for $10,000 and a credit to common stock for $10,000. Once the journal entry was created, then we can post the entry into the ledger so that we could show the specific effect of the account as an increase or a decrease to the account. This slide shows for event number 2 the same process. Notice here that where Sierra borrows $5,000 and signs a $5,000 note for the $5,000 cash, cash goes up with a debit of $5,000 and the notes payable increases by $5,000 with the credit. Notice what happens here on the ledger. We keep the first transaction of $10,000, but now we add the second transaction of $5,000. At this point in time, we could actually add the two debit entries together at that point of the transaction and say on October 1st, the company had $15,000. On the third transaction on October 2nd, Sierra used $5,000 in cash to purchase the equipment. We did the analysis and we noted that the cash went down by $5,000, but the equipment went up by $5,000. Because equipment is an asset, we're going to increase the equipment account with a debit, and we're going to decrease cash by $5,000. Now let me stop right here and note to you that in the journal entry, notice that the debit entry is recorded first and the credit entry is recorded second. The credit entry is also indented so that we can quickly identify which ones of the accounts are debits versus credits. Now take a look at the posting after event 3 has occurred. We still maintain the $10,000 from event 1. We maintain the $5,000 from event 2, but now we've added the $5,000 credit to cash so that when we take all our debits and subtract out all our credits, we'd have a remaining balance of $10,000. Taking event number 4. We looked at on October 2nd that Sierra received $1,200 in cash advance from Robert Knox, a client for guide services for a multi-day trip. Remember here, we haven't earned the revenue yet, but we've received the cash. So cash has gone up by $1,200 and the liability account titled Unearned Service Revenue increased by $1,200. The unearned revenue account is a liability because now we have an obligation to provide a service to the customer or to give them their money back. Event number 5, on October 3rd, Sierra receives $10,000 in cash from Copa Company for guide services provided in October. So remember what we said is that they earned the $10,000. Cash went up by $10,000, so we debit cash, but the service revenue increased by $10,000, so we do a credit because revenues increase with credits. Take a look at that cash account now. That cash account has 4 debit entries and 1 credit entry. Event number 6, on October 3rd, Sierra pays office rent for October in cash of $900. Cash goes down for $900, but rent expense goes up by $900. So we know that expenses increase with a debit, and we know that assets decrease with a credit. So we debit rent expense for $900 and we credit cash for $900. Event 7, on October 4th, Sierra pays $600 for a 1-year insurance policy. Remember, because this was for a 1-year policy, this transaction was a prepaid expense, not an expense yet until each month occurs. So we increase an asset account called prepaid insurance by $600, and we show that we paid out the cash for $600. So debit prepaid insurance $600, credit cash $600. Event 8, on October 5th, Sierra purchases an estimated 3 months of supplies on account from Aero Supply for $2,500. The asset supplies accounts goes up by $2,500, and we paid on account or in credit, so we have an obligation to pay in the future of $2,500 called accounts payable. So debit supplies $2,500, credit accounts payable $2,500. Event 9 was when we hired the 4 employees. Each employee will receive a weekly salary, but they haven't done the work yet. So there is no transaction because the work hasn't been done. Event 10, Sierra pays $500 cash dividends to its stockholders. So cash goes down, but dividends goes up. So if we go back to our chart, an increase to dividends is a debit. A decrease to cash is a credit. So debit dividends $500, credit cash $500. Event number 11, on October 26, Sierra pays employees salaries of $4,000 in cash. So we've recognized that we have received a service from our employees. We've received the benefit, so we have an expense. So we're going to increase the salaries and wages expense account by $4,000, and we're going to decrease the payment of cash by $4,000. So what we see on the general journal is a series of transactions of debits and credits to show for each transaction that has occurred. Then we've taken the transactions from the journal and posted them into each of the ledger accounts that are illustrated by using T accounts on this screen. Notice what we take at the end of the period is that we take all the debit entries and credit entries and determine what the ending of balance is for each one of the accounts. If we take the cash, the supplies, and the prepaid insurance and the equipment, we know that those are all assets. Then we take the notes payable, the accounts payable, and the unearned service revenue, and we know those are all the liabilities. We know that under stockholders' equity, common stock, dividends, service revenue, and the salaries and wage expense and rent expense all are under stockholders' equity. Once we have those totals for each of the accounts, we can create what we call a trial balance. A trial balance is a listing of all the accounts that have balances in them at that point in time. We should be able to show the debit balances or credit balances for each one of the accounts and add up all the debits and all the credits to make sure that our debits equal our credits and that our accounting equation stays in balance. This trial balance will help us to determine that we've posted all our debits and credits correctly. It does not tell us that it went into the correct account, but it does tell us that the dollar amount went into the correct debit or credit column. Once we've identified that everything is still in balance, we then can create our financial statements. So we can take a trial balance that looks something like this for Sierra Corporation. Note all the debit and credit balances, and when we add up the two columns, they equal. So, what is the trial balance good for? The trial balance is good for making sure your debits equal your credits. It will not tell you these 5 things. It will not tell you that a transaction did not get journalized in the general journal. It won't tell you that the journal entry that was in the general journal was correctly done. Also, the journal entry could have been posted more than once, and that would not be caught. Also, if it was posted to the wrong account, we would not know that. And then finally, the 5th one, offsetting errors could mess things up even more. So, while the trial balance is a good tool to make sure our debits equal our credits and that our accounting equation remains in balance, it isn't foolproof. It doesn't tell you if you've made a mistake in the posting process.